we need to talk about the 5 big mistakes I see new investors making that you want to avoid, and sometimes not so new investors. But when you make these mistakes, keep making these mistakes, they can cost you a fortune in the long run. So the first mistake is to start investing before you have an emergency fund. And why this is a problem is that if you don't have an emergency fund, and it's not that you need like the hugest emergency fund to, start investing a little bit, but without an emergency fund, your investments are vulnerable. You're going to end up having to use your investments or your 401k as a piggy bank anytime you have unexpected expenses. And you don't want to be doing that. That may have you selling investments at the wrong time. It may have you, especially in a 401k, paying taxes and fees and penalties, and you don't want to be doing that. And it can have you selling investments when they're down, and maybe you'd rather hold those investments. So don't use your investments as your emergency fund. Save up at least something of an emergency fund where you can get through your average month or two with some extra expenses without having to use your investments as a piggy bank. Mistake number 2, only investing in a 401k is a big mistake. Now, why is that? I know the ubiquitous advice is max out your 401k, and 401ks can give you a tax deferral, which can be cool. It can also be dangerous. I'll tell you why. And you might get a match with your 401k. Now, matches are super cool, and if you get a match, you want to take advantage of that match. But usually the match is maybe just for the first few percentage points, and then there's a max that is a much higher amount. And I would suggest investing to the match and not to the max, because if all of your investments are in your 401k, first of all, you're going to be subject to the rules and the regulations of your 401k. Maybe later in life, you've got a big pile of money there and you're like, hey, I'd like to buy a second home or buy a rental property or start a business. And that's when people discover that money isn't as flexible as they wish it was. And if you pull a bunch of money out later in life, you may pay a big amount of taxes, penalties, fees, etc. You want to avoid that. The other problem is when all of your investments is there in your 401k and you're building up a big amount, you could actually be maximizing your costs and your fees, which drain your investments, but you could also be maximizing your future income taxes. When you invest in a brokerage account and you hold that money long term, you're going to pay long-term capital gains at a much lower tax rate. Now, this may not apply if you're just pulling, small amounts of money out in the future, but it's one reason why you want to diversify where your investments are, because you can save money, you can invest money in different ways that will have different taxation, and that can be a beautiful thing in the future when you're trying to, manage not paying too much in taxes. Mistake number 3 is putting all of your investments in the stock market. When people think of investments, a lot of times we think of stock market, and the stock market can be a great place to invest. It historically has been a very good place to invest. And it's also very volatile. When all of your money is in the stock market, that money is subject to the systemic risks of the stock market. And even if you're invested in companies that are awesome, blue chip companies, when the stock market dives down, those companies could lose a lot of value as well. Even if there's no difference, still the same company, still just as profitable as last year, but maybe the value of that stock has gone down 20 or 30% or more. So we have to be very cautious in diversifying. And when we diversify into different asset classes. This is something I'm going to be talking about more in my upcoming Money Momentum class. Let me know, leave a comment if you want details on that, because diversification leaves us much more stable. If you think about a stool, a one-legged stool, that's called something that falls over. Two-legged stool again, not stable, but we want several legs, 3 or more legs for sure on that stool. The more legs, the harder it is to knock over. Okay, mistake number 4. Putting money in a target date fund. Okay, maybe there's some good ones out there. I don't know. These are literally the most popular investments right now. And I've done my research. For years, I've been researching these, and they are notorious. And if you don't know what a target date fund is, sometimes they're called life cycle funds. They have other names, but usually target date fund, life cycle fund. It's a fund that you buy this one size fits all, it's this all-inclusive fund, and it's based on your desired retirement date. And usually they come in 5-year increments. So you could have there's a 2015 fund for people who are already retired. There's, the 2025, the 2030, 2040, 2050 fund. So these funds are notorious for underperforming the stock market. They're also notorious for a lot of baked in fees, and they also have, because any sort of fund like that has to be disclosed of what it is invested in, they're not flexible in terms of the management. So they tend to perform very poorly. And a friend was asking about a company lately. They sell life insurance and mutual funds. I'm not going to name the name, but they also have a multi-level strategy in terms of recruiting representatives, advisors. And I looked up their target date funds, and I was appalled. I was so mad I could hardly sleep that night, because they are just losing people's money, hand over fist. Some of their target date funds had lost 37%, 50%. One of them had lost, I believe, 67% the last year. And then I zoomed out, and, last year was not a great year for the stock market, so it's not unusual that funds, are down for the year. But then, when I say for the year, for 2022, I zoomed out, I looked at the 5-year, and for those that have been around for 10 years or more, the 10-year history. A lot of the 5 and 10-year history had, again, either lost money or gained very little. In almost every case, you'd be better off having your money in a savings account than in the target date funds. And the ones that had lost money over the last 5 or 10 years, I don't know how you lose money in the biggest bull market over the last 10 years in the history of the stock market. I don't know. I shared this with a friend of mine who does investments, and she's like, are they hiring 22-year-old fund managers? I don't know. Is it hookers and blow? I don't know. But these funds, people love to buy them because they think, oh, this is easy, this is automatic, my money's going to be managed for me. But if you're not looking at what the results are, and I realize, past results don't indicate future results, but if those funds have lost money over the last 5 years, that is a lousy fund. And I didn't see any funds with this company that even did half as well as the S&P 500. So you could invest in some super easy automatic way and beat the returns of most of these funds. Okay, end of soapbox. And the 5th and the last mistake is not doing your own research, not doing your own diligence, simply sitting down with a salesperson. And, that's how most investment advice is given these days, as you sit down with a salesperson who may or may not represent a broad range of products, and the more narrow range of products they represent, typically the more bias they may have, which doesn't mean that you won't sit down with an awesome, life insurance person, agent who maybe doesn't sell other kinds of investments, but I know people in life insurance, they're like annuity specialists and they're awesome at life insurance. But just be aware, like, do your own research, learn, do your own due diligence, get more than one opinion. You get multiple opinions, whether it's mine or somebody else's. The opinions, they're not going to be the same. You're ultimately going to have to make your own decision. And I don't think that's a bad thing. Get the professional advice and make your own decision, because nobody will ever care more about your money than you. So we need to, while we get advice, we also need to put our own thinking caps on. And that's one reason why I am launching Money Momentum. It's a little bite-sized class that I'm doing 6 weeks, actually 7 weeks, with, I just added a bonus early bird session on financial trends, looking at financial trends of the last year and the next year, where we might be headed. And I love doing financial education. I don't sell mutual funds or stocks or life insurance or annuities. I don't sell any financial products, because I love empowering people with information and helping them understand the investment landscape, so they're prepared to make smarter decisions, and they're prepared to recognize when something is a bad deal and they know how to go check out something and make sure they're not buying into a fund managed by a 22-year-old with no ethics or experience. You want to avoid that. Okay, so let me know if you want to know more about Money Momentum. I'll leave a link in the description. Like and subscribe if you got value out of this, and have an awesome rest of your day. Remember, you are powerful, you're prosperous, and you are free. Bye-bye.